Stock of the day is Cisco. We're going to take a look at where Cisco's been and also where it might be in 5 years' time. Now, very few companies can boast that they were once the world's largest company, but Cisco Systems is one of those elite companies, and that's been reflected in its share price. But let's look back to the fun-filled era known as the dot-com bubble in 2000. During those heady days, Cisco was a darling of the US stock market. Its bullish share price was unstoppable, and its market cap peaked at more than 550 billion. Briefly, Cisco was the biggest tech behemoth in the world. But alas, those exciting days didn't last. When the bubble burst, the internet solutions company lost more than 80% of its value. From $80 a share, it plunged to 10. Until now, Cisco has yet to surpass its all-time peak share price, attained nearly a quarter of a century ago. So, is Cisco a good long-term investment? Well, this really depends on your starting point. The Cisco share price spent a decade or so between 2002 and 2012 digesting its earlier boom-bust cycle. Only after 2013 did the enterprise networking company start a gentle bull trend. While we note a series of higher reaction lows, the stock has stalled in recent years at $60. In 2023, the $210 billion company recorded revenues of 57 billion. Gross margin exceeded 60%. Free cash flow was a chunky 15 billion. In other words, Cisco's financial health is solid. However, as most astute investors will know, the financials of a company and how its stock price behaves can sometimes disconnect. The post-pandemic stock boom didn't really help set Cisco's stock on fire, like Tesla, for example, and this means that investors no longer see Cisco as a leading tech company as they did before. Sentiment is focused on the so-called Magnificent Seven stocks at the moment. Of course, fans of Cisco will highlight the company's healthy sales and earnings growth over the past few years. This is true. Cisco currently sells enterprise architectures, SD Access, and Cisco Security Cloud and support services. These products have recurring revenue. Therefore, Cisco does appear to have good long-term prospects. But from the investor point of view, to get a better risk-reward ratio here, it may be worth holding positions and perhaps waiting until Cisco's share price corrects to the $30-40 band, which technically looks like support before allocating a full position. On the subject matter of whether or not Cisco is undervalued, valuation is a fluid subject. The same company can be valued at wildly different capitalizations over a short space of time. Currently, the market isn't too excited about Cisco. As I said earlier, the full attention of the bulls is concentrated on AI stocks like Nvidia, Microsoft, or Meta, formerly Facebook. For Cisco, it's operating under the radar, so to speak. But is the company undervalued? For one, Cisco's price-earnings ratio is a respectable 15 as a comparison. This is half that of Apple, who trade on a P ratio of 30, or Google on 29. Cisco's dividend is good at 3%. The $1.45 payout per share is not too bad when compared to other large tech stocks. And from these metrics, you could say that Cisco has good value compared to other leading tech companies. That said, when investing in Cisco, you must be prepared to hold for the long haul to reap the benefit of an upward reevaluation. A stock, for whatever reasons, can remain mildly undervalued for an extended period of time. In 5 years, who knows, Cisco may become even better valued. If you want our most up-to-date analysis on Cisco and our rating, go to the Good Money Guide, search Cisco.